This short tutorial introduces the concept of relevant and irrelevant costs for financial decision-making. Financial decision-making involves choosing which of a number of alternative courses of action is best for the organization. Financial decisions apply to short time horizons. The types of financial decision that a company may need to make include: should the company add or drop a product or business segment? Should the company make a component or buy the component from a supplier? Should the company accept or reject a once-off special order? How should the company get best use of scarce resources? Should the company change the method of performing an activity? Financial decisions involve comparison of the future cash flows of alternative decisions. When making a financial decision, some cash flows are relevant to the decision, while other cash flows are irrelevant to the decision. In this tutorial, we consider what costs are relevant and what costs are irrelevant. We'll look at three different types of cost: incremental costs, sunk costs, and opportunity costs. Firstly, we consider incremental costs. Incremental costs are defined as the difference in cost between two alternatives. Incremental costs are relevant in decision-making. Next, we consider sunk costs. Sunk cost is cost incurred in the past that cannot be recovered. Sunk costs are irrelevant in decision-making. Let's take an example. John runs a delivery company. He bought a truck 4 years ago for $30,000 and insures the truck for $1,000 per annum. John plans to increase the activities of his business. Increased business activities will increase John's fuel bill from $300 to $600. Increased business activities will increase John's repair bill from $800 to $1,000. What is the total relevant cost of John's decision? Firstly, we consider the cost of the truck. Whether we consider the old business or the new business, the truck cost is $30,000. The question is this cost relevant to the decision John is making today? As the cost of the truck occurred in the past, today's decision will not change what we paid for the truck. Thus, the cost of the truck is a sunk cost. Sunk costs are not relevant to today's decisions. Next, we consider the increase in the cost of fuel. Before considering increasing his business activities, John spent $300 on fuel. If he decides to increase his business activities, John's fuel bill will increase to $600. Is this increase in cost relevant to the decision? Yes, this incremental cost of $300 is related to the additional business activity, so is a relevant cost. Next, we consider the increase in the cost of repairs. Before considering increasing his business activities, John spent $800 on repairs. If he decides to increase his business activities, John's repairs bill will increase to $1,000. Is this increase in cost relevant to the decision? Yes, this incremental cost of $200 is related to the additional business activity, so is a relevant cost. Finally, we consider the cost of insurance. John pays insurance of $1,000 regardless of whether he increases his business activity or not. Is this $1,000 cost relevant to the decision? As the cost of the insurance occurred in the past and does not change due to the additional activity, the insurance cost is not relevant to today's decision. Hence, the total relevant cost of John's decision is $500. Next, we consider opportunity costs. Opportunity cost is profit forgone as a result of taking a given course of action. Opportunity costs are relevant in decision-making. Jane currently earns $20,000 per annum and is considering leaving her job to attend a course to qualify as an accountant. As an accountant, she'll earn $50,000 per annum. What is the opportunity for Jane? To earn $50,000 per annum. What is the cost of the opportunity? Jane will lose her salary of $20,000 per annum. Thus, the opportunity cost of Jane's decision is $20,000. This short tutorial introduces the concept of relevant and irrelevant costs for financial decision-making. We looked at three different types of cost: incremental costs, sunk costs, and opportunity costs.